Britain learned early that controlling banking meant controlling destiny of nations. Rivals built central banks hoping stabilized currencies would protect emerging economies. But London viewed these institutions as threats challenging its financial supremacy. Thus began forgotten war fought quietly through ledgers, treaties, and economic sabotage. Europe entered 18th century, seeking independence from Britain's growing monetary influence. States created central banks issuing notes guiding their national economic development, but Britain recognized danger. Strong rivals could disrupt trade and credit. Banking power shifted politics, and Britain refused to surrender financial dominance peacefully. The first shots were silent, fired through targeted manipulation of credit. London bankers denied loans to governments attempting independence from British networks. Without financing, new central banks struggled maintaining stable national monetary systems. Britain weaponized liquidity, ensuring competitors lacked necessary support for survival. France attempted building strong central banks stabilizing economy after revolutionary turmoil. Britain responded by disrupting French credit channels through coordinated market pressure. English financiers withdrew support, forcing French currency into dangerous volatility. Economic instability weakened France, ensuring reliance on British-dominated financial markets continued. Environmental shocks worsened situation, allowing Britain to exploit weakness more aggressively. French crops failed, driving inflation, which central bank could not control. Britain used crisis increasing pressure through commodity speculation, deepening France's economic collapse. This attack crippled financial innovation, preventing France from matching British strength. Spain attempted reforming monetary system, establishing central bank linking fractured regions. Britain targeted Spanish silver supply, manipulating global bullion prices, disrupting stability. Silver shortages eroded Spain's reserve confidence, undermining central bank credibility dramatically. Financial vulnerability restored British influence over transatlantic trade and colonial wealth. Prussia built disciplined fiscal system using central bank to strengthen monarchy. Britain feared powerful Prussia could challenge its position within European markets. London initiated bond market attacks, raising Prussia's borrowing costs dangerously high. Debt burden undermined reforms, weakening financial foundation of Prussian central authority. Sweden introduced pioneering central bank building Europe's earliest modern monetary system. Britain monitored closely, fearing innovation could spread, threatening long-term global dominance. Speculators connected to London destabilized Swedish currency, weakening national financial confidence. Economic turmoil restricted Sweden's ability, challenged Britain's expanding international influence. Austrian Empire sought unity through central banks stabilizing diverse regional economies effectively. Britain intervened subtly by flooding markets with rival foreign currencies. This speculation destabilized Austrian coinage, limiting central banks' policy effectiveness significantly. Empire remained fragmented financially, ensuring Britain retained advantage across continental trade. Britain realized disrupting rival central banks prevented emergence of strong unified opposition. Monetary instability crushed confidence in governments seeking independence through financial reform. Britain won battles by simply denying stability required for national growth. Central banks collapsed because empire wielded money as masterful geopolitical weapon. Europe understood too late central banks required independence from Britain's trading network. However, London controlled commodities, insurance, shipping, and global settlement systems. Central banks lacked infrastructure necessary, resisting pressure from British financial alliances. Britain dominated because global trade routes depended on London's established institutions. Foreign central banks relied heavily on British bullion traders, maintaining reserves steadily. A single refusal to supply metal forced nations into dangerous contraction. Britain used selective denial of gold to weaken rival monetary authorities. This leverage crippled independence, forcing reliance on London's financial stability. Diplomats protested privately, but governments lacked leverage, challenging Britain's supremacy effectively. Publicly they claimed progress, while quietly negotiating access to London's markets. Central banks needed British trust more than Britain needed their cooperation. Power remained with those controlling liquidity, not those issuing printed notes. Rival banks attempted issuing large loans, financing national industrial expansion rapidly. Britain restricted foreign capital flow, making borrowing excessively expensive abroad. High interest rates derailed infrastructure projects, weakening national economic foundations. Loans became traps, exposing fragility of systems, lacking British endorsement. London merchants collaborated, using networks extending across Europe and its colonies. They controlled flow of goods, undermining revenue, disdaining rival central institutions. Economic starvation created chaos, disrupting operations of inexperienced national banking systems. Britain exploited their weakness, ensuring continued dominance through commercial superiority. International investors trusted London over experimental banks, emerging across European capitals. Without foreign deposits, rivals lacked resources stabilizing their expanding economies. Confidence shaped reality, making British banks indisputable guardians of global stability. Central banks failed partly because world believed only Britain ensured safety. When crises erupted, European states turned to London seeking immediate liquidity support. Britain provided loans at terms, ensuring long-term dependence on British institutions. Central banks survived only by accepting constraints, eliminating their monetary autonomy. Dependence strengthened Britain's geopolitical leverage across fragile, struggling European nations. Wars offered Britain additional chances, destroying credibility of rival banking systems. Military conflict drained reserves faster than central banks could replenish them. Britain targeted supply chains, disrupting revenue necessary, sustaining wartime monetary stability. Central banks collapsed because empire sabotaged economic resources supporting their operations. Napoleonic Wars revealed how quickly central banks unravel under prolonged financial strain. France printed money without bullion reserves, causing rapid uncontrolled inflation. Britain defended gold standards, strengthening perception of financial responsibility globally. This contrast destroyed trust in French banking, ensuring Britain's supremacy continued. After Napoleon fell, Europe sought stability through reorganized financial institutions and reforms. Britain guided negotiations, shaping systems, aligning with London's economic interests. Foreign central banks adopted structures resembling British model, reinforcing UK leadership. Victory allowed Britain rewrite financial architecture of post-war continental Europe entirely. Industrial age accelerated importance of banking, requiring nations modernize monetary operations. Rival central banks attempted innovation, facing immediate pressure from British financiers. Technological advances meant little against global networks controlled from London's markets. Britain remained anchor because influence spread across commercial, maritime, and colonial sectors. Italy unified, seeking to create strong central bank supporting new nation-state unity. Britain withheld support, questioning Italian monetary stability in global markets. International investors followed Britain, isolating Italy financially during critical formative years. Weakness grew, ensuring London remained dominant economic voice within Mediterranean region. Russia attempted modernizing banking to fund infrastructure and expand industrial capability. Britain exploited inexperience, manipulating foreign exchange rates, affecting Russian reserves. Currency instability undermined reforms, limiting Russia's challenge to British dominance. Invisible sabotage produced economic setbacks, discouraging further expansion of Russian financial independence. Netherlands rebuilt financial sector, seeking restore influence lost during earlier rivalries. Britain intervened, manipulating trade tariffs, affecting Dutch maritime profitability sharply. Reduced revenue weakened banks, unable to support national development plans effectively. Economic reliance on Britain re-emerged, despite Dutch attempts to recover previous status. Britain understood central banks only function when public confidence remained stable. Thus, Britain targeted psychology influencing perception of strength within rival economies. Rumours spread through traders created panic, weakening currencies without justification. Confidence disappeared, quickly destroying authority of nations pursuing independent banking innovation. London newspapers contributed, subtly shaping opinion across Europe regarding financial reliability. Reports emphasized British stability, overshadowing rivals experiencing periodic monetary shocks. Media influenced investor behavior, strengthening British dominance in global credit markets. Perception: war won victories impossible through conventional military or diplomatic confrontation. British brokers influenced commodity markets, controlling prices essential for foreign economies. When rivals depended on wheat, sugar, cotton, or metals, Britain intervened. Commodity volatility ruined budgets, relying on predictable trade revenue for stability. Central banks failed maintaining control when reserves collapsed under unpredictable prices. Paris, Vienna, Berlin, and Madrid all experienced disruptions engineered through British networks. Each crisis reinforced the impossibility of competing against London's coordinated financial alliances. Every collapse strengthened Britain's position as Europe's undisputed monetary commander. Rival central banks faded into obscurity, and Britain victorious in silence. By 19th century, central banking in Europe emerged, shaped by British dominance. Structures mirrored London's approach, integrating systems into global British financial order. Nations gained stability, but sacrificed autonomy, securing Britain's geopolitical advantage. Central banks survived only when functioning within framework Britain secretly established. Invisible war achieved goals without combat through disciplined manipulation of money. Britain ruled through currency, credit, and confidence, controlling international financial behavior. This forgotten conflict determined future of Europe's monetary landscape permanently, undeniably. Britain's financial empire expanded by quietly crushing rivals' earliest central banks, and no history textbooks rarely mention this silent struggle for dominance. Its consequences shaped centuries of economic order throughout modern European development. Britain's victory ensured financial leadership recognized worldwide as unchallenged global authority. Banking supremacy achieved quietly became foundation of Britain's enduring international power. Britain strengthened power by mastering invisible warfare fought through currencies and credit. Nations pursued independence, believing central banks protected them from outside manipulation. But Britain controlled global settlement systems, limiting autonomy of foreign monetary authorities. This dependence ensured rivals remained vulnerable to strategic disruptions engineered by London. Foreign governments underestimated the extent of British intelligence gathered from financial channels. Invisible networks monitored borrowing patterns, revealing weaknesses exploitable during economic crises. Britain anticipated instability, enabling early intervention, shaping outcomes across European markets. Knowledge granted advantage, restricting rivals from building strong independent financial foundations. Central banks across Europe attempted reaching gold parity, stabilizing their national currencies. Britain controlled gold distribution, deciding which nations achieved convertibility and when. Selective access reshaped hierarchy, forcing rivals remain behind. London's managed stability. Gold leverage reinforced power, making Britain indispensable to global monetary security. Bond markets became battlefield where Britain controlled success of foreign fiscal reforms. High yields signaled weakness, discouraging investment in rival national projects. Speculators aligned with London amplified volatility, undermining fragile continental confidence. Central banks collapsed under pressure, unable to neutralize coordinated British financial attacks. Trade treaties allowed Britain impose tariff structures favoring London's commercial interests. Foreign currencies weakened when export revenue declined after treaty implementation. Weaker currencies forced nations borrow more, increasing dependence on British financiers. Tax and trade policy quietly reinforced Britain's financial privileges across Europe. Foreign central banks tried issuing paper money backed by limited metal reserves. Britain targeted those reserves, influencing value of foreign paper circulating locally. Speculative attacks devalued notes, creating panic among merchants and international investors. Public distrust destroyed reforms, ensuring Britain retained dominance across monetary transactions. Diplomats saw cooperation promising stability if Britain eased pressure strategically. But Britain demanded structural reforms, aligning monetary systems with London's designs. Concessions ensured central banks remained subordinate, protecting British geopolitical financial superiority. Diplomacy mass coercion shaped through Britain's mastery of economic leverage. Newly formed banks attempted diversifying reserves away from British-controlled gold supplies. Britain blocked efforts, using trade dominance, influencing the flow of global bullion. Reserve shortages crippled central banks, undermining trust in their long-term stability. Dependency deepened, ensuring Britain maintained control over rivals' financial lifelines. Britain influenced internal politics, guiding appointments, leading major foreign central banks. Candidates sympathetic to London secured leadership, strengthening British influence internally. Policy decisions aligned with British frameworks, reducing risk of opposition emerging. Rivals unknowingly adopted practices favouring Britain's agenda within monetary governance. During industrial expansion, rivals required credit backing large infrastructure and economic growth. Britain controlled international bond markets, determining which nations received affordable financing. Unfavourable rates hindered projects, weakening central banks unable to support long-term investment. Financial bottlenecks slowed development, preserving Britain's industrial and commercial advantage. When foreign governments attempted restructuring debts, Britain intervened, shaping negotiations decisively. Terms favoured British investors, protecting their assets against risky sovereign defaults. Reforms restricted central bank activity, ensuring monetary discipline aligned with British priorities. Negotiations preserved British influence, transforming crises into opportunities for consolidation. Economic nationalism across Europe tried protecting industries through tariffs and subsidies. Britain countered threatening currency destabilization if protectionism expanded significantly. Governments retreated, fearing collapse of reserves central banks could not protect. Nationalist efforts failed because Britain weaponized global finance against domestic defiance. Britain developed reputation for stability, attracting deposits from wealthy European elites. Money flowed into London, depriving rival central banks of necessary domestic capital. Foreign currency weakened as liquidity evaporated, strengthening British monetary position. Capital flight, orchestrated silently, ensured Britain's supremacy across international financial networks. Wars in Balkans created volatility exploited by Britain to weaken surrounding banks. Currency instability spread rapidly, forcing governments borrow from British lending houses. Dependence increased, aligning regional monetary policy with Britain's geopolitical objectives. Conflict offered opportunity, expanding influence further across vulnerable Balkan states. When Ottoman Empire attempted central banking reform, Britain intervened decisively and quietly. Loans imposed harsh terms, binding Ottoman finances to British lenders permanently. Reforms stabilized empire superficially, but surrendered monetary autonomy entirely. Britain absorbed influence, shaping economic policies within collapsing imperial structure. European powers criticized British tactics, but relied on London during emergencies. When crises struck, only Britain provided immediate stabilization, preventing catastrophic economic collapse. This assistance increased influence, making rivals tolerate British intervention reluctantly. Central banks survived because Britain allowed them, not because they succeeded. Colonial wealth strengthened Britain, providing foundation funding global financial operations. Rivals lacked empire-scale resources, limiting their monetary flexibility during crises. British gold, commodities, and trading influence outmatched continental banks systematically. Empire transformed into engine powering Britain's dominance in central banking warfare. London's financial press shaped narratives, influencing investor confidence across multiple nations. Articles questioned stability of foreign banks, sparking capital withdrawals instantly. Public opinion turned against rivals, damaging credibility critical for central stability. Narrative warfare proved as effective as economic sabotage, undermining continental reforms. Foreign monarchs negotiated privately with British bankers, ensuring survival of their treasuries. These private deals influenced national budgets, limiting independence of monetary decisions. Promised support came with conditions favoring British influence across political structures. Hidden agreements shaped evolution of Europe's financial landscape for generations. Revolutions across Europe tested resilience of central banks, threatened by internal instability. Britain exploited chaos, offering selective aid, determining winners of political struggles. Financing ensured friendly governments survived, while hostile regimes lost economic support. Invisible intervention shaped future of nations, far beyond battlefield outcomes. America observed Britain's tactics, learning importance of central banks for global influence. But early American systems lacked depth Britain built through centuries of experience. Britain monitored American developments, preparing countermeasures, safeguarding its privileged position. Financial intelligence ensured threats neutralized before challenging British monetary dominance. Germany united seeking build central bank rivaling Britain's international financial role. Britain responded by targeting German bonds, influencing yields through strategic speculation. Higher borrowing costs slowed industrial expansion, restricting Germany's global financial reach. Britain protected dominance, preventing emergence of a centralized continental threat. Britain controlled maritime insurance, influencing flow of goods essential for revenues. Foreign central banks failed stabilizing currencies when trade disruptions reduced government income. Insurance rates engineered through London weakened rivals, dependent on smooth shipping. Maritime financial warfare reinforced central bank collapse without direct political confrontation. London's clearing system processed international payments essential for global commerce. Foreign central banks relied on access, enabling settlement of cross-border transactions. Britain restricted settlement, causing severe liquidity shortages inside rival economies. Payment disruptions crippled nations, revealing vulnerability inherent within global dependence. When European treaties considered unified monetary cooperation, Britain intervened strategically. Lobbying prevented creation of institutions, challenging London's authority over currency stability. Fragmented systems benefited Britain, allowing divide and rule approach within financial community. Centralization abroad threatened dominance Britain eliminated through diplomatic manipulation silently. 20th century began with Britain controlling world's strongest currency backed by gold. Rivals attempted parity that lacked resources, and networks required maintaining convertibility. Market attacks weakened foreign currencies, reinforcing respect for British monetary leadership. Confidence remained cornerstone of British influence, sustaining central banking supremacy. World War I drained Europe, destroying central banks struggling to survive unprecedented financial strain. Britain borrowed heavily yet retained credibility foreign banks failed achieving. Post-war era saw Britain reorganize European debts, shaping monetary recovery direction. Foreign central banks accepted British oversight, ensuring stability within devastated Europe. Interwar years created instability exploited by London's hidden financial alliances effectively. Nations experiencing hyperinflation or debt defaults sought British assistance desperately. Britain shaped reforms aligning global finance with its preferred monetary architecture. Nations capitulated, adopting frameworks, reinforcing Britain's enduring financial authority. World War II created conditions altering financial landscape, but preserving British influence. Although weakened economically, Britain retained control through historical institutional dominance. Foreign central banks depended on systems Britain helped construct after earlier conflicts. Legacy ensured Britain remained guardian of financial stability across post-war world. After war, new institutions emerged, but still mirrored British banking traditions closely. Central banks followed principles developed by British financiers over previous centuries. Britain shaped global governance through legacy cemented during forgotten bank war. Victory persisted because world adopted frameworks originally forged within London. Thus, Britain's supremacy in banking survived through strategic manipulation and calculated patience. No rival overcame advantage Britain built, disrupting early continental financial independence. Central banks abroad existed, but operated under shadow of British authority. Invisible victory shaped world where London remained unchallenged financial commander. If this story revealed power hidden in silent economic battles, remember, empires fall when their financial systems lose breath. Subscribe for more untold histories buried under global money wars. Because the next conflict will start inside a bank, not a battlefield.